It's the afternoon of January 16th, 2026, and your screen is lying to you. Right now, the mainstream tickers are a sea of red. Silver just got slammed, over 3% down in one trading day. Gold's sliding too. Market pundits are already calling this the death knell for the metals rally, the moment the commodities boom hit a brick wall. And if you're watching CNBC or skimming through the usual financial feeds, you'd think the entire thing just collapsed. But here's what no one's telling you. As silver takes this emotional nosedive, as retail traders dump in panic and financial influencers cry crash, there's one metal holding steady in a way that gives me chills. Copper, $5.86 per pound, refusing to budge, like it's bolted to the floor. Now look, I've been studying commodity markets for over a decade. I built this channel to cut through the noise long before the headlines catch up. I'm not here to stir hype. I'm here because I saw something this afternoon that couldn't wait till tomorrow's spin cycle. While everyone's watching the panic at the exits, I'm watching the side door. And what I saw was this. Amazon Web Services, yes, AWS, just skipped over the entire public market and locked in a copper deal right at the source. A 2-year direct supply agreement with Rio Tinto. No LME, no COMEX, just straight acquisition. Samsung's doing the same. These aren't bets. They're calculated, deliberate moves to corner a resource the world's biggest tech firms cannot risk running out of. So ask yourself, if copper was just another industrial metal headed for a dump, why are global giants signing multi-year supply deals right now? Why are they paying a premium just to lock it in? The screen's giving you one version, but the shadow market is revealing something very different. And if you think silver's plunge is the headline, you're missing the real event, something that's been building for 175 years beneath the surface. Because this isn't just a sell-off, it's the moment copper stops being a commodity and starts being valued for what it truly is, a strategic asset. It is, quite literally, the new gold. And the institutions? They're front-running the public. Before anyone else even notices there's a squeeze coming. Thesis and trigger. Here's the foundation of this entire thesis, and I need you to lock this in, because everything else flows from it. Copper is no longer just a tradable material. It is rapidly becoming a critical tech resource. One that Amazon, Samsung, and every serious player in AI and electrification are hoarding before Wall Street even wakes up to what's coming. This isn't about today's price swings. This isn't about riding hype. This is about understanding a fundamental revaluation of the world's most essential metal. What we're witnessing is what I call the Great Divergence. Gold and silver are being treated like panic insurance, assets you buy when you're scared the system is breaking. And don't get me wrong, I own physical silver. I get it. I've been in that world a long time. But copper is oxygen for infrastructure. It's the one material you must have to build the next 2 decades. AI server farms, electric vehicle rollouts, smart grids, high-speed rail, every futuristic project we've been promised runs through copper. And here's the uncomfortable reality the media won't admit. Supply can't catch up, not for years. Not because of supply chain issues, not because of shipping delays, but because of the hard science of mining. It takes 12 to 15 years to go from discovering a copper deposit to full production. Ore grades have dropped 30% since 2000. The easy copper is gone. And yet, demand is accelerating at a speed that would have sounded crazy 5 years ago. So here's what I'm going to do in this breakdown. First, I'll walk you through the current market structure, real-time price behavior, inventory shifts, institutional flows, all the data the mainstream is too slow to catch. Second, I'll break down the macro mechanism, the copper-to-gold ratio. This is the #1 signal for tracking when markets switch from fear to growth, from precious metals to real tech metals. Third, I'll crunch the numbers. No hype math, no fantasy charts. Just the hard supply-demand curve showing why $5 copper isn't some price spike. It's the new normal for a world that has to electrify. Fourth, I'll challenge my own thesis. I'll take the strongest bearish case I've heard, and I'll try to tear this view apart. If I can't beat the best counterpoint, then I've got no business pitching this. Finally, I'll show you my personal playbook. Not advice, not a call, just the actual signals I'm watching and how I'm preparing as this shift unfolds. This isn't a short-term trade. It's a historic macro signal that's been quietly forming for more than a century, and now it's about to break into full public view. And most people, they won't see it coming. My promise is this. By the end of this video, you'll understand that the real story isn't today's sell-off. It's the silent copper withdrawals happening at the LME that no one is talking about. Let's dig in now. Real numbers, real signals. Let me walk you through exactly what I was staring at earlier today. January 16th, early afternoon, Eastern Time. Gold is sitting at $4,188.12, down $21.84 on the day. Silver, 88.55, dropping hard with a sharp 3.15% loss. It's the kind of brutal red candle that shakes retail traders to their core, making them question everything they thought they understood. Meanwhile, copper, $5.86 per pound. And here's the thing. While gold and silver are tumbling and headlines are yelling about the so-called collapse of the commodity supercycle, copper, it's steady. Not soaring, not crashing, just steady. And in this kind of macro storm, that stability says more than a vertical rally ever could. Let me walk you through that. When you pull up the copper CFD chart, you'll see something interesting, a dense liquidity zone right at 586. Despite the chaos in metals, despite risk-off signals across the board, despite every macro excuse for copper to follow the pack lower, it's holding its ground. The 550 to 580 range, still intact. I call that tectonic stability. It's not flashy, it's not exciting, but it is revealing. It tells you large institutional hands are anchored under this market, and they're not letting it drop. Now compare that to silver. Silver's experiencing what traders call a flush. Fast, emotional, reactive. It's paper-driven, headline-fueled, fear-based selling from retail and algorithmic players trying to preempt some imagined crash in the metals space. And look, I get it. When silver drops over 3% in a day, your gut tells you, is this the start of something worse? But here's the divergence. While paper traders are unloading silver contracts, Amazon Web Services, yes, AWS, is locking in multi-year copper supply straight from Rio Tinto. No intermediaries, no exchange, direct offtake. Samsung's doing it too. This isn't speculation. They're not looking to flip contracts for profit. They're calculating how much copper they need to fuel their long-term infrastructure, data centers, AI clusters, electrification, and securing it now, even if it means going around public markets entirely. That's not what corporations usually do in a so-called commodity crash. That's what they do when they know something the public doesn't. So ask yourself, what are these giants preparing for that Wall Street isn't pricing in? Yes, the silver dump is real. The fear is real. But the quiet copper withdrawals from the London Metal Exchange? Also real. And while retail is selling the dip, these companies are quietly hardwiring copper into the future they're building. I've seen this movie before. When price action and physical market behavior split this wide, you follow the physical, because screen prices can lie, sentiment can flip, paper contracts can be created in seconds, but you can't fake a copper mine. The teaching block, macro rotation, begins here. Let's take a breath because this is where things really matter. We need to talk about the copper to gold ratio. Now I know, ratios sound dull, like something buried in a textbook you never finished reading. But trust me, this one's different. Because this ratio is a kind of economic seesaw, and right now, it's leaning in a direction most people aren't positioned for. Here's how to understand it. On one side, you've got gold, the ultimate defensive asset. Wealth insurance, a store of value that's weathered 5,000 years of history. On the other side, copper, a pure industrial necessity, the metal that powers construction, electrification, AI infrastructure, and the next phase of civilization. Think of it this way. You buy gold when you're afraid of inflation, collapse, currency risk. You buy copper when you're building data centers, EVs, clean energy grids. So the copper-gold ratio tells you, is the market playing defense or offense? When the ratio is falling, it means fear is winning. Capital is moving into gold. That's your classic recession setup. Risk off, liquidity dry up, capital preservation. But when that ratio climbs, it means capital is rotating into growth, infrastructure, real economy bets. And this is the trap most metals investors are stuck in. They've been trained to see gold and silver as end-of-cycle lifeboats. And yes, sometimes they are. But when the ratio starts to tilt, when copper starts outperforming, that's a signal. The market is shifting from fear to forward motion. If all your capital is still positioned in defense, while the cycle rotates to offense, You're fighting the last battle, not the one ahead. Let's zoom in technically. The copper-to-gold ratio just completed what Elliott wave analysts would call an ABC flat correction. If you don't speak chart patterns, what that means is the market took time to digest gains, consolidated into a stable zone, and now it's emerging from that base. The seesaw, it's tilting. Now look, I'm not saying gold is about to crash. I'm not saying silver's obsolete. What I am saying is this. The cycle is leaning toward assets with utility, not just symbolism, toward metals of construction, not just protection. And these kinds of macro shifts don't happen in a flash. They unfold, quietly at first, until the real economy makes the message loud and clear. This is not some sudden flip of a switch. It's a slow, grinding rotation, one that can stretch out over months, even years before it's fully priced in. But the early movers, the big players, the tech titans and infrastructure leaders of the next decade, they're not waiting for a CNBC segment to tell them it's real. They're already taking positions. Here's why that matters for you. If you're only watching gold and silver and basing your worldview on what they're doing, you're not seeing the full picture. The market is whispering a new message. The age of playing pure defense is fading, and it's being replaced by an era of calculated offense. And copper is leading the charge. Let me give you the analogy that made this all click for me years ago when I was still trying to decode how commodity cycles really behave. Imagine a war. In the early stages, when survival is uncertain and fear runs high, your priority is defense. You build bunkers, store ammo, stay alert. That's gold. That's silver. That's what we call the fear trade. But eventually, if you want to win, you don't just hunker down. You advance. You need to build supply chains, produce tanks and power, forge tools of offense. That's copper. That's the growth trade. And that's exactly what the copper-to-gold ratio is signaling now. We're moving from survival mode into build mode. Now here's where I need to hit pause and zoom in on what's actually happening. Because this isn't some vague theory or macro daydream. Look at what AWS just did. Look at what Samsung is doing. LME copper inventories are quietly drying up even as corporate offtake contracts pick up steam. The rotation isn't on the horizon. It's already started. The institutions just haven't put it on the front page yet. The numbers don't lie. Let's run the math. We need to look at the hard data. If I can't put numbers behind this thesis, then it's just noise. Another hot take lost in the crowd. So let's start with demand, specifically EVs and the power grid gap. A standard gasoline-powered vehicle uses about 20 kilograms of copper. Starter motor, wiring, alternator, basic components. An electric vehicle, around 80 kilograms per car. That's a 4x increase in copper per unit, and we're not talking about niche adoption anymore. Every major automaker on Earth is committing to full EV transitions within the next 10 to 15 years. Scale that across global production. We build roughly 80 million vehicles per year worldwide. If even half of those become electric, that's 40 million EVs. Multiply by 80 kilograms per car, and you're looking at 2.4 million metric tons of additional copper demand just from automobiles. But that's only the beginning. AI data centers are the new black hole of copper demand, and 5 years ago, no one had that priced in. A single large-scale data center can require between 5,000 to 10,000 metric tons of copper for everything from cooling systems and energy infrastructure to power redundancy and high-speed connections. And we're not building a few. We're building hundreds. Microsoft, Google, Amazon, Meta, they're all locked in an arms race to dominate AI infrastructure. And for every kilowatt of AI compute they add, they need copper to keep it running without meltdown. Now add renewable energy on top of that. Solar farms, wind turbines, grid-scale batteries. Every component is copper-hungry. Just one offshore wind turbine, roughly 8 metric tons. Solar farms, around 5 to 12 metric tons per megawatt of output. The International Energy Agency estimates we'll need to triple global renewable capacity by 2030 to hit climate goals. That's not wishful thinking. That's the bare minimum. So when you combine EV growth, data center expansion, clean energy projects, and ongoing industrial demand, you're looking at the most deeply embedded, multi-decade demand surge the copper market has ever seen. This is not cyclical demand. This is structural, locked-in necessity for modern civilization. Now let's flip to supply, and this is where it gets messy. Copper supply isn't just tight, it's trapped in a time delay. Bringing a new mine online takes 12 to 15 years on average. That's not a guess. That's the reality when you include exploration, permitting, environmental checks, financing, construction, and actual ramp-up. But here's the real kicker. Since 2000, ore grades have declined by 30%. Translation? Mining companies now have to dig 30% more rock to extract the same amount of usable copper. The easy high-grade deposits? Already gone. What's left is deeper, lower quality, and more expensive to access. So even if demand stayed flat, supply would still struggle. But demand isn't flat. It's exploding. Let's do a basic stress test. Assume global copper demand grows just 3% per year. That's a conservative assumption, honestly. But let's roll with it. Right now, global copper demand is around 25 million metric tons annually. 3% growth means we'll need an extra 750,000 metric tons every year just to keep up. But here's the problem. There aren't enough new mines in the pipeline to meet that growth. According to S&P Global, the copper market is on track to face a cumulative supply gap of nearly 10 million metric tons by 2030 if nothing changes. Let that sink in. 10 million metric tons. And there's no shortcut. You can't 3D print a copper mine. You can't skip the physics. So unless we dramatically alter the development curve, that shortage becomes a reality. That's not some rounding issue you can patch with efficiency tweaks. It's a hard structural gap, and it's not getting closed by marginal gains or wishful recycling narratives. Speaking of which, let's confront that myth right now. Yes, copper is highly recyclable. Roughly 30% of global supply does come from scrap and reclaimed material. But here's what most pro-recycling arguments conveniently ignore. Not all copper is created equal. The copper reclaimed from old wiring, plumbing, and motors, it doesn't meet the ultra-high purity thresholds needed for next-gen technologies. You can't just melt down old pipes and expect to get copper suitable for AI cooling systems, high-frequency EV architecture, or semiconductor-grade circuits. The metallurgy doesn't work like that. For those mission-critical, high-tech applications, you need virgin copper, freshly extracted and refined to exacting standards. So yes, recycling helps fill baseline industrial demand, but it's not enough for the bleeding-edge technologies that are driving the next major wave of consumption. Now, let's talk about where this really gets compelling, the financial modeling. If you run a discounted cash flow, DCF model on copper producers using a $5 LB long-term price assumption, it looks like there's already a good amount of upside baked in. But here's the problem. $5 isn't the bull case anymore. It's the new base case for a global economy that requires electrification just to function. And when you layer in real-world cost pressures, equipment, fuel, wages, regulation, the all-in sustaining cost, AISC, for many miners is creeping toward 4LB. That leaves just a $1 margin, barely enough to justify the billions needed to finance new supply. For capital to flow into new mining development, the incentive price needs to rise. Sustainably. We're talking 6-7 LB copper, not as a spike, but as a long-term average. And the current market, still priced for a much cheaper world. So what we're seeing isn't a moonshot setup. It's what I call a tectonic revaluation. Slow, relentless, and baked into the industrial evolution curve. This isn't going to be a parabolic run that catches fire in a few weeks. It's a grinding repricing as the physical copper quietly gets absorbed into multi-year supply agreements faster than new production can come online. And that brings us to the final piece of the equation. If the math is this clear, if the deficit is this visible, why isn't copper already at $10 LB? Because of one word, skepticism. And that brings us to the section I call the Steelman test. Let's hit pause and do something that too many analysts skip. We need to build the strongest case against everything we've discussed, and then try to hold up against it. If I can't answer the best counterargument, then I don't deserve to hold the thesis. So let's recap what we've covered. AWS and Samsung are locking in copper directly from the source. Copper's holding 586, while gold and silver are getting slaughtered. The copper-gold ratio is signaling a shift from defense to growth. Supply deficits are real, structural, and growing. Recycling won't solve the purity gap. Now, here's the best bear case. A major global recession will crush demand. And I'm not talking about a mild 6-month dip. I mean a deep drawn-out industrial slowdown, a full-blown collapse in manufacturing and capital expenditure. one where the Purchasing Managers Index, PMI, stays underwater for a long time. If that happens, the argument goes, this whole supercycle narrative falls apart because all this talk of EVs, data centers, and green infrastructure assumes economic growth. But if credit dries up, if companies pull back, if stimulus stops flowing, then those projects get delayed or shelved. And copper, being a classic cyclical metal, gets punished. It's a strong argument, and it's not a straw man. So let's address it. First, yes, copper is cyclical. In a global downturn, demand will slow. That's the nature of industrial commodities. I'm not going to pretend that doesn't happen. But here's where this cycle breaks from tradition. The corporate offtake behavior is telling us something new. Look at what AWS is doing. They're not trying to time the bottom. They're not betting on a price move. They're trying to de-risk their supply chain because they know that if they wait for the recession discount, there might not be physical supply left to buy. That's the shift. In past commodity cycles, demand was fungible. You could delay construction. You could defer purchases. You had slack. This time, not so much. If you're Amazon and your business model depends on AI scaling, you can't put that off for 5 years. If you're an automaker that's committed to going all EV by 2035, you can't pause your copper contracts just because the economy hiccups. You've already invested billions into retooling, supply lines, and long-term obligations. That's what we mean by locked-in demand. Could a harsh recession slow the pace of all this? Sure. Could it delay some deployments? Of course. But it won't eliminate the structural need for copper. Because the global direction on climate, energy security, and tech infrastructure is already locked in. We're not going back to analog. Even if demand dips temporarily, here's what happens next. Copper prices soften, mining companies cut capex, projects get shelved or slowed, and when the economy recovers, the supply hole is even deeper. That's the trap. Most people underestimate how long it takes to turn copper supply back on, and by the time they realize it, the floor has moved permanently higher. Unlike manufacturing, where you can shut down a factory and bring it back online within months, mining doesn't work that way. You can't just pause a copper development project and expect to resume it on short notice. Once a major mining operation is halted, years get added to the timeline. So ironically, while the recession argument is valid in terms of short-term volatility, it actually reinforces the long-term case. The supply gap only gets worse. Now, let's move to the second major objection. Recycling will bridge the gap. I hear this one constantly. Copper's infinitely recyclable. As prices rise, scrap will flood the market. Sounds logical, right? But here's the metallurgical reality recycling enthusiasts leave out. Recycled copper isn't pure enough for the future we're building. Yes, I touched on this earlier, but it's worth repeating, because this is the fatal flaw in the entire recycling argument. When you melt down old plumbing, scrap wiring, or industrial machinery, the result is mid-grade copper, good enough for building wiring, good enough for general use conductors, but nowhere near clean enough for advanced sectors like AI infrastructure, high-efficiency EV drivetrains, or semiconductor connections. Those applications require ultra-pure copper with near-zero impurities, and unless you're willing to re-refine scrap to that standard, which is expensive and energy-intensive, it's not going to cut it. So yes, recycling will remain part of the picture, but it cannot meet the soaring demand from next-gen technologies, and those are the very sectors driving the structural uplift in copper needs. Now let's take on the third skeptic argument. China's slowdown kills the bull case. It's true. China accounts for roughly half of global copper demand. So if China enters a prolonged economic slump, yes, global demand would take a hit. But here's what that argument misses. China isn't just the world's largest copper consumer, it's also the largest investor in green infrastructure, solar, wind, batteries, grid storage. Even as its real estate sector cools, its electrification efforts are accelerating, and the global picture is evolving. India, Southeast Asia, and Latin America are now scaling their own infrastructure efforts. Copper demand is diversifying geographically. It's not a single country story anymore. So would a Chinese slowdown hurt? Yes. Would it unravel the entire global demand thesis? No, because the rest of the world is now stepping into its own growth cycle. Conclusion. Steelman recap. We've given fair ground to the bear case. Recession risk is real. Copper could experience price dips in a global downturn, but the structural forces, electrification, Locked-in capital projects, long-term supply inertia, those remain firm. So if your time horizon is weeks or months, yes, there's risk. But if you're thinking in years, trying to align with the mega cycle, the bear case falls apart. You can't print copper mines. What happens next? We've outlined the thesis, walked through the math, and addressed every meaningful objection. Now let's talk about how this actually unfolds in the real world. First, watch what the institutions are doing. I'm keeping a close eye on both the LME and COMEX for margin changes. Here's why that matters. When inventories tighten and volatility creeps higher, exchanges often raise margin requirements. It's a risk management move, but it also pushes out speculators and removes leverage from the system. If we start seeing rising margin requirements while shadow withdrawals are accelerating, that's a sign the paper market is under pressure. And when that happens, price discovery breaks. Now, what are shadow withdrawals? The LME reports visible inventories, but that only reflects what's stored in registered warehouses. What it doesn't show is the copper that's being privately withdrawn, pulled directly into corporate stockpiles via off-exchange contracts. The AWS and Samsung deals, they're not reflected in the LME data. That copper is already spoken for, so you could look at the official charts and think inventories look fine. Meanwhile, spot availability is quietly vanishing. This is what I call the dark inventory phase. The most important industrial metal on the planet won't even be on the open market. It'll be locked in private agreements for years. Sound extreme? Go back and study the lithium market. Automakers didn't wait. They secured long-term supply directly from miners. Copper is following the same path. The media narrative. This is where behavioral psychology enters the picture. Expect financial media to stay laser-focused on silver's volatility. Why? Because volatility sells. Fear gets clicks. A 3% crash in silver? Instant headline. A slow copper grind upward over 6 months? Crickets. It's not manipulation. It's attention economics. So the story will be about metals crash, retail pain, the collapse of the supercycle. Meanwhile, institutions will keep quietly hoarding copper through backdoor deals, off the radar. It's the oldest move in the playbook. Keep retail glued to the loud, shiny asset, while the real prize slips into quiet hands. My personal dashboard. What I'm watching now. Here's the real-time dashboard I'm tracking. 1. LME inventory trends. If registered stock keeps falling while direct supply deals rise, that confirms the squeeze is shifting off exchange. I'm not looking for a collapse, just a slow, steady bleed. If inventory shrinks even as price stays flat, it means availability, not price, is setting the rules. 2. The 550 floor. If copper holds above 550 lb during the next market-wide sell-off or macro panic, that signals the decoupling is real. That wouldn't just signal price strength. It would mean copper is no longer trading like a typical cyclical metal. It's behaving like a strategic tech resource, backed by institutional demand that's not going anywhere. Third indicator, the spread between physical premiums and futures prices. If we begin to see spot copper trading at a significant premium above futures, it's a sign the physical market is much tighter than the paper market is admitting. We saw the same setup during the early 2000s oil spike. Futures were still pricing in soft growth, but physical barrels were commanding sharp premiums because real-world supply was vanishing. Copper is starting to echo that pattern. Let me be absolutely clear. None of this will explode overnight. This isn't a meme stock moment. There's no copper short squeeze coming next Friday. This is a multi-year revaluation arc, and it's going to move so slowly that most people won't realize what's happened until it's too late. Prices might drift sideways between $5 and $6 for months. We might even see a drop to $4.50 if we get a serious recession scare. But the core fundamentals? The supply crunch, the corporate lock-ins, the non-negotiable electrification wave. Those are immune to day-to-day volatility. So here's the most likely scenario over the next 12 to 18 months. Gold and silver. Expect turbulence, big up days, big down days. Retail traders will get thrown around. Financial media will keep calling tops and bottoms. Noise everywhere. Meanwhile, copper will grind. It'll hold floors, occasionally spike on supply headlines, but mostly it'll do the one thing nobody notices, refuse to fall. Behind the scenes, corporations will keep quietly locking in supply. LME inventories will continue a slow decline. Miners will delay projects, miss budgets, and warn of cost overruns. And one day, maybe late 2026, maybe early 2027, the market will finally wake up to what's been unfolding this whole time. And when that happens, the move won't come from hype. It won't be driven by momentum. It'll come from the fact that the metal is gone, already absorbed into long-term private contracts, and the market will be forced to reprioritize copper's value in real time. My battle plan, not advice. Let me walk you through what I'm doing personally. This isn't financial advice. This isn't a pitch. This is just my framework, my decision tree. Here's how I'm thinking about it. I track the copper to gold ratio daily. If that ratio continues to climb while silver stays trapped or suppressed, that's my cue to rotate focus from precious metals to industrial tech metals. That doesn't mean I'm selling my silver. I've been stacking for over 12 years. That's long-term insurance. It stays untouched. But when I'm looking for asymmetric upside over the next 1 to 2 years, my attention is shifting toward copper. Now let's talk about how to gain exposure. You've got options. Option 1, physical copper. You can buy rounds or bars, but copper is bulky, heavy, and not exactly stacker-friendly. Liquidity is an issue. Option 2, futures or CFDs. These give you direct exposure to price, but they carry leverage risk, rollover costs, and complexity, only for experienced traders. Option 3, copper equities. This is where I think most retail investors have a shot, specifically the Global X Copper Miners ETF, COPX. It offers diversified exposure to major producers and gives you leverage to copper price without betting on a single company. My triggers trigger A. If copper closes a week above 580, while broader markets are under pressure, stocks down, metals down, risk off everywhere, but copper stays firm, I'm personally adding to COPX. Why? Because that signals a structural bid, not speculation. That's confirmation that institutions are holding the line. That's when I step in, not at the bottom, at the trend confirmation. Trigger B, if copper breaks below 520 on a sustained basis. Not a flash crash, but a clean weekly close under 520. I stand down. That tells me the China drag is outweighing the AI electrification tailwind, for now. That's a wait-and-watch moment. I won't catch a falling knife, I'll wait for a new base. Final pattern watch. Now here's something I really want you to focus on. The bid-ask spread on copper CFDs. Liquidity is thinning. Market makers are backing off, widening spreads. That means they're uncertain. They don't know where the next wave is coming from, buy or sell. And when spreads widen in a so-called bear market, it often signals the bear phase is ending. This is where the real battles are fought, not in headlines, not in sound bites, but in the order book, the open interest, and the withdrawal sheets published quietly at 4 a.m. Here's the tight loop I'm watching every week. Copper price versus gold, daily ratio movement, LME inventories, looking for slow bleed, not collapse, off-exchange supply deals, AWS, Samsung-style activity. Price versus risk appetite. If copper holds while risk sells, that's confirmation. If copper confirms strength above $5.80 during broader market weakness, I'll continue increasing my position in COPX at a size I'm comfortable riding through volatility. This isn't a hype trade. This is the institutional accumulation phase, quiet, slow, and mostly ignored. But when it flips, you'll want to be holding before the headlines catch up. If copper breaks below 520, I'm stepping aside. I'll reevaluate once a lower base forms, and while all that plays out, my physical silver stack stays untouched. That's my insurance, not my growth engine. This isn't about getting rich overnight, it's about being strategically aligned with a multi-year shift the market hasn't fully absorbed yet. Here's what 12 years in commodities has taught me. The biggest moves don't show up when everyone's watching. They start in silence, while the institutions build positions and the retail crowd chases noise. Right now, that noise, it's silver, shiny, volatile, clickable. But copper is the quiet freight train rolling beneath it all. And I know which one I'm watching. Let's tie it all together. 3-sentence recap. Silver's the headline. Copper's the chapter that matters. The AWS and Samsung moves are early signals in what's shaping up to be a massive corporate supply grab, bypassing exchanges entirely. The macro rotation, from precious metals to industrial tech metals, is already underway. Wall Street just hasn't updated the headline. Now for my final take, and I want to be deliberate, not dramatic, because hype kills clarity. Over the next 12-18 months, I expect copper to do the one thing that frustrates both bulls and bears: grind sideways while building higher lows. No vertical moonshot, no sudden crash, just a tight, choppy range that slowly sets a new floor. But beneath that slow movement, corporate procurement is tightening, exchange inventories are bleeding, mine development is stalling, demand from AI, EVs, and renewables is ramping hard. At some point, the disconnect between paper pricing and physical scarcity will break, and when it breaks, it won't be subtle. I'm not saying copper hits 10 lb tomorrow. I'm saying 5 lb is the new baseline, the cost of survival in an electrified economy. Once you internalize what it actually means for a commodity to be reclassified as strategic infrastructure, you'll understand exactly why the smart money is already moving. Don't let red candles on your screen distract you from the seismic shift happening underground. The era of copper as just another metal is done. The era of copper as strategic tech infrastructure has begun. While the headlines mourn the end of the metals boom, the real capital is locking in the one resource that can't be faked, printed, or replaced. You can scroll past it. You can wait for a segment on CNBC. You can dismiss it as just another cycle, or you can pay attention to what AWS is doing, to what Samsung is securing, to what every single tech titan, EV builder, and AI superscaler is doing right now. They're not speculating, they're stockpiling. They're cutting past exchanges and bidding above market for guaranteed copper flow. They're not betting on price. They're building a future they know can't run without it. So here's the question you need to ask. Are you positioned for the past or for what's already arriving? The metals crash story. That's yesterday's news. The copper supply crisis. That's tomorrow's reality. And tomorrow is closer than anyone thinks. If you want to understand why inventory is vanishing before exchanges can even publish the numbers, if you want to track what's happening behind the curtain, in shadow vaults and closed-door procurement deals, watch this space, because the institutional world has already made its move. The only question left is whether you'll make yours in time.